All right. Good morning, everybody. Good morning, all you magnificent melon heads of the world, and happy Friday, everybody. That week went fast, didn't it? Today is August 8th, 2025. The top story this morning is the mess in gold markets. Yesterday afternoon, late afternoon, we got the announcement that we've got tariffs on gold. Okay, that's interesting because a few months ago, we had the surprise announcement that there were not tariffs on gold. And then before that, there was the anticipation of tariffs on gold. On again, off again, on again with tariffs. And, well, if you're a trader and you're looking for certainty, you didn't get it yesterday, that's for sure. So what happened? We had a Swiss refiner sent a letter to Customs and Border Patrol. And Customs, the refiner is basically asking, hey, you guys put these 39% tariffs on Switzerland recently. Does this apply to gold or not? And in a surprising answer, the CPB said, yes, it does. Basically, gold bullion, refined in Switzerland, is going to be subject to those 39% tariffs. And look, guys, the gold business, the refining business, and the gold dealing business is an industry with razor thin margins. I mean, really thin. And you don't just absorb 39% tariffs. That doesn't happen. That basically kills the gold trade between Europe and the U.S. Now, this is starting to make quite a big mess because remember, there's two gold prices. There's two very important gold prices, and they're separated by an ocean. You've got the spot price, which is determined on the London Metals Exchange. All right, that's the European price. That's spot. When you go into a coin shop, you say $3 over spot, right? That's the London price that they're talking about. But then you've got the price for gold futures on the COMEX, which is here in New York. That's right, the paper gold price. And so what we're seeing right now, because there is this wall of 39% tariffs in between the two, you've got the price in New York is going up substantially, while the price in London does pretty much nothing. It actually went down a tiny little bit. Gold in New York in December is now worth almost $100 an ounce more than gold in Europe. And look, if you're short gold, right? Like say you're one of these guys, you're hedged or whatever, or you're speculating, you say, I think gold's going to go down. I take out a short on gold. I bet against it in the COMEX. Well, I have got to deliver metal to the COMEX exchange in New York when that contract expires. And if your plan was to go to Switzerland and buy that gold when you need to deliver it, well, your cost just went up 39%. Oops, you're hosed. So what are you going to do? You're going to go close out that short position. You're going to go buy back that short. And you have a lot of people doing that right now. Is it a short squeeze? I don't know that I would use a short squeeze to describe that, especially because it's kind of like bringing back 2021 vibes. But you definitely got a lot of people who are betting against gold who are rushing to unwind that bet right now. Now, prices haven't gone crazy. But they could. It's making a mess. Look, silver's kind of doing the same thing, not as big of a move, but if these tariffs apply to gold bullion, then they probably apply to silver bullion as well. It's just making a mess, and I can't really tell you what this is going to look like in 6 months. For all we know, 5 minutes from now, we're going to get some other clarification that says, nope, that letter was sent in error, tariffs don't apply. On again, off again, on again, off again kind of thing. So I honestly just can't tell you what this is going to do to the market because we've never had anything like this happen in the market. I have a couple of theories. Right now they're playing out. We're seeing that exchange for physical, that difference in price between New York and London just widened dramatically. It went as high as $120 an ounce last night. Now, the other big development also happened late yesterday. We got the announcement from President Trump that the chair of the White House Economic Advisors, Stephen Miran, will be the new governor at the Federal Reserve. Now, it's very important. This is not the new J-Pow. Stephen Miran is being appointed to replace Adriana Kugler, who resigned unexpectedly last week. And Stephen Miran is being appointed as an interim Fed governor, which means he's not permanent, at least not yet. So this is not like a shadow chair, as some people were worried about. His job is not going to be to go in there and undermine Jerome Powell. That being said, what do we know about this guy? Well, he's probably going to be another voice for rate cuts on the FOMC. He's going to be a voting member. Trump wouldn't have put him in there if he didn't promise to vote for rate cuts. So, it's a good bet that this is a move in a dovish direction for the Federal Reserve. A little bit on Miran's background. He's the chair of the White House Council of Economic Advisors. He's a senior strategist at Hudson Bay Capital Management. He's also a fellow at the Manhattan Institute. That's a conservative think tank. And he's also, in the past, he was very critical of the Federal Reserve under Biden. He was very critical of their uber dovish monetary policy, something that's kind of contrary. If he's going to come in and start voting for rate cuts now, well, that's a little bit hypocritical, if you will. He was also highly critical of Secretary Yellen during her time at the Treasury and her over-reliance on the issuance of T-bills in order to suppress long-term interest rates. Well, that's something his guys are doing too. Secretary Bessent has kept that tradition alive of relying too much on T-bills. And of course, Stephen Miran was also the author of the Mar-a-Lago Accords. Now, that was a policy proposal that is now defunct. The key feature of the Mar-a-Lago Accords was a 100-year bond in the United States with a 0% interest coupon attached to it. It was basically a way to make Europe pay for all the NATO water carrying that the United States does. And, well, that got thrown out the window when Trump and Vance and Zelensky had that historic blow up in the Oval Office. And Europe said, you know what? Probably not a good idea for us to just overly rely on the United States for our own protection moving forward. And so any carrot, stick, whatever that we had for the Mar-a-Lago Accords went away. Europe decided they were going to bankrupt themselves trying to rebuild their own militaries instead. And we wish them luck with that. So those were the two big things that the market had to digest yesterday. The net result, we had gold, silver, and Bitcoin move higher, both on the heels of, likelihood of more dovish monetary policy, plus the tariffs on gold. We had those dollar alternative assets rallying. Now, we've also got some other stories going on this morning. SoftBank is buying a defunct EV plant in Ohio from Foxconn, trying to get a little bit of movement on Project Stargate, which is notoriously stalled. We had shares in Trade Desk are getting absolutely wrecked right now. They reported earnings yesterday that were pretty good, showing decent growth, but they replaced their CFO with a board member. They're demoting her. Market does not like sudden changes in the C-suite. We got Wendy's cut their outlook today on some weak sales. Shares of Block they're just ripping this morning, doing fantastic. Block posted earnings. That's the owner of Square and the Cash App. Possibly a sign of some consumer health there. At risk of sounding optimistic, Block put up some pretty good numbers. Maybe that means consumers are still spending. We got a worrying trend over in England. Rolls-Royce has sold their pension liabilities, or basically paid an insurance company to take on their pension liabilities. We are seeing this trend of pension buyouts by insurance companies in the UK. Not sure that's necessarily a good thing. We'll talk about that. And we've also got a big decline in Chinese autos. You guys may recall it was a couple of months ago that the Chinese Communist Party summoned all the electric vehicle execs and said, yo, knock it off with the price cuts. You guys aren't paying your suppliers. You're causing problems at the factories. You're causing deflation. We're trying to fight deflation. And so the Chinese EV makers stopped with their obscene price cuts. And now we're seeing a big across-the-board decline in auto sales, not just EVs, but all autos in China. And this latest data, once again, we got a lot to talk about this morning. How about we shrink my big melon of a head, and let's see what's going on in the markets this morning. Hey, don't forget that like button and that subscribe button for the YouTube algorithm if you're new here, so you can come back tomorrow and have your coffee with the melon heads as we go through markets. And as always, in lieu of absolute catastrophe, number go up. That is no different this morning. Stocks are higher. Once again, the S&P is up by 15 points, or 0.24% to the upside. We've got the Dow is higher as well by 90 points, 0.21% in the green this morning. And the NASDAQ is up 0.16%, 38 points to the upside. Stocks up pretty much across the board here. Meanwhile, the U.S. dollar is a little bit stronger here at 98.25. That's up 16 basis points, still within the band it's been trading at for the last couple of days. Looking over at the bond market, we got yields are higher on the long end of the yield curve. The 30-year Treasury is at 4.843. That's up by 3 basis points. The 10 years at 4.265, up almost 1 point. The 2 years at 3.750, that's up a point and change. And the 1 month is even up a point, 4.360 for the 1 month T-bill. All right, now let's talk about what's going on in commodities here this morning. First of all, look at gold. Look at these two numbers here. You've got right here, this is your December gold futures, $3,488 for gold delivered in New York in December. And then underneath it, this XAU USD, that is the London spot price, $3,395, nearly $100 difference between the two. The December gold future is up by $35.55. The spot price of gold is actually down by 50 cents. So you're seeing this divergence between the New York and the London price, right? That's traders in New York closing out their shorts because it's going to cost them 39% to get that gold here from Switzerland. That is how the tariffs have just made a mess in New York. And honestly, guys, I just don't know what this is going to look like over the course of many months. It's probably a good time to talk to Bob Coleman, bring him back on the channel, make heads or tails out of this. But to a lesser extent, we're seeing the same thing in silver. We've got the September front month silver contract is at $38.55. That's up a quarter or about 0.7% this morning. Meanwhile, spot silver barely moving, $38.31. That's only up a nickel. So you're seeing the price in New York moving faster than the price in London here. Either way, guys, I still like the shiny, even though I just couldn't tell you what the hell is going on in the metals markets right now. Copper, meanwhile, is higher by 1%. Platinum is higher by platinum is lower by 0.75%. Palladium is down 2.3%. And crude oil at $63.91. That's up a couple of pennies for September WTI. Looking over at Bitcoin, it had a pretty good day yesterday on the heels of that executive order that allows cryptocurrency into 401ks. Plus, it moved on the appointment of Stephen Miran to the Fed Governor's Board. Right now, though, it's down a little bit from yesterday's highs, $116,607. That's off by about $900. But Bitcoin still moving up off of its 50-day moving average where it caught a bounce several days in a row. All right, here's the actual article in question. This is the big story. Gold bars hit by surprise U.S. tariffs, unleashing new turmoil. A U.S. move to put tariffs on imports of gold bars is unleashing fresh turmoil in the bullion market, with prices spiking in New York as dealers brace for a major reordering of global trade flows. U.S. Customs and Border Protection has clarified that 1 kilogram and 100-ounce gold bars are subject to reciprocal tariffs enacted by President Trump and are not exempted as the industry had initially understood. That's according to a letter from the agency seen by Bloomberg. The ruling was first reported by the Financial Times. Gold futures in New York, which are backed by those forms of bullion, surged to record highs as traders, analysts, and executives across the industry were left reeling. The move threatens to disrupt shipments from Switzerland and other key trading and refining hubs, including Hong Kong and London, where prices are now trading at a big discount to the U.S. market. Traders and analysts are scrambling to understand the full scope and consequences of the ruling, including whether the CBP would treat larger 400-ounce bars that underpin trading in London in the same way, and what the levies for major gold-producing countries will be. The potential market consequences are so profound that some question whether the dramatic change could be an error on the CBP's part and suggested it may be subject to legal challenges. So you have a little bit of disbelief here in the market. First of all, everybody's saying, all right, you clarified on the kilo bars and the 100-ounce bars. They're subject to tariffs. What about the 400-ounce bars? That's the one they use for settlement in London. You didn't mention that. So I see no reason why they would exempt 400-ounce bars and not 100 in kilos, but still they didn't specifically call it out, so that's a question mark. You've got these traders that are saying, no, we think this is a mistake. There's no way they're going to do this. And look, they're reflecting that even further. We scroll down here a little bit. It's unclear whether other types of gold bars, such as 400-ounce bullion, that's the most traded in London, will be subject to tariffs. If not, those could simply be shipped to the U.S. and recast into 1 kilogram blocks, said a manager of a major refinery who declined to be named as they're not authorized to speak publicly. Such a scenario would still render the CME contract unviable, according to Nikos Kavalis, managing director at consultancy Metals Focus Ltd. Since the U.S. only has limited gold refining capacity, the gap between the spot price and the futures price will be prone to issues of capacity. I just don't see that as being in anyone's best interest, he said. I suspect that this is a misunderstanding or an error on the part of customs authorities, or if not an error, let's say a poor assessment. I suspect it'll be legally challenged or lobbied. So once again, you have people saying, no, this can't be right. I mean, the CPB letter was pretty clear. Reciprocal tariffs do apply. But these guys are questioning that. Either way, guys, it's going to make a mess in the gold market for quite a while. This is not something that is going to just sort itself out in short order. And we've also got this warning from UBS about the same tariffs here. UBS has warned that U.S. tariffs on large gold bars could spark disruption. UBS is warning that the U.S. tariffs on large gold bars could spark disruption in funding markets as the higher costs prompt a mass closeout of short exchange for physical positions. The unwinding of these trades, which are typically settled in London, would trigger a sudden demand for cash and liquidity in the city's bullion market, potentially tightening funding conditions. So they're worried about a cash shortage in London now. That is very interesting. Because the U.S. tariffs now hit large gold bars, a lot of traders holding those short EFP positions may decide to close them out instead of delivering physical gold into the U.S., because doing so is now much more expensive. Closing out these positions means they need to buy back the futures and unwind the physical delivery side. That unwinding process will create a sudden need for cash and liquidity in London's gold market, because the physical leg of these trades, which is financed, has to be funded or replaced. In short, tariffs will make delivering gold into the U.S. pricier, so many traders will pull back and close their positions, and that mass closure creates funding stress in the London market. I mean, look, nobody is saying short squeeze here, but that's what this is sounding like. It hasn't quite played out this way, but they're saying it without actually saying it. Again, we just don't know, guys. I don't want to be like, go pile into gold. It's going to the moon. Like, it's not what I'm trying to do here. I've always been very bullish gold and silver. All I can tell you is this thing is making a mess. All right. Now on the other big issue of the day, Trump to nominate economic advisor Stephen Miran to be the new Fed governor, replacing Kugler. It's important to note he is replacing Kugler. He is not replacing Powell. President Donald Trump on Thursday announced he has selected Stephen Miran, chair of the Council of Economic Advisors, to a pivotal seat on the Federal Reserve Board of Governors, replacing Adriana Kugler, who resigned on Friday. The nominee will serve out Kugler's term, which expires January 31st of next year. So this is an interim appointment. In the meantime, we will continue to search for a permanent replacement, Trump said in a Truth Social post, indicating that the nominee for the full 14-year term on the board could be someone else, and Miran may just be in a caretaker role. The president has been pushing for sharply lower interest rates. Miran is a past critic of the Fed, specifically its aggressive stimulus actions during the COVID crisis. In addition, he's the author of the controversial Mar-a-Lago Accords, a plan to devalue the dollar as a way of managing the current account deficit problem for the U.S. He was critical of previous Treasury Secretary Janet Yellen's decision to purchase short-term treasuries as a way to manage the national debt. By selecting Miran, Trump has made a stopgap appointment and given himself until January to make the main call, said Marco Casagiri, a senior economist and strategist at Evercore ISI. This way, Trump did not tie his hands, keeping his options open regarding the choice of the new Fed governor and especially the new Fed chair. Miran still needs Senate confirmation to the 7-person board, something unlikely to happen until the upper house reconvenes in September. The rate-setting FOMC, of which he would be a permanent voting member, next meets September 16th and 17th. Markets widely expect the committee to approve its first cut since December. So we got what's likely to be another dove on the FOMC. I don't know that this actually makes any big difference in the long run, because the Fed is right now widely regarded as pretty much guaranteed to cut in September. A lot of people were surprised they didn't cut already. That being said, look, this guy was very critical of previous dovish Federal Reserves. Now he's being put in there to be a dove. Is this guy going to be an actual policy analyst? Is this someone who's going to look at the data and make a decision? Or is this somebody who is just going to do what he's told? We'll just have to wait and see. All right, we got a couple other ones going on this morning. This one's interesting. SoftBank's making a lot of news lately. Yesterday, we were talking about how SoftBank hasn't spent any of the money they promised to spend on Project Stargate. This morning, we got this one. SoftBank buys Foxconn's Ohio plant to jumpstart Stargate AI push. SoftBank Group is the buyer taking ownership of Foxconn Technologies' electric vehicle plant in Ohio, a move aimed at kickstarting the Japanese company's $500 billion Stargate data center project with OpenAI and Oracle. SoftBank, which has struggled to create a financial blueprint for Stargate, had approached Foxconn to get the Apple supplier on board with its plan to build data centers and related infrastructure throughout the U.S., people familiar with the matter said. The EV plant sale is a result of those efforts by the Japanese investor, they said, asking not to be named as the discussions remain private. Earlier this week, Honhai Precision, the flagship unit of Foxconn, said it had agreed to sell the EV plant to Crescent Dune LLC for $375 million without identifying the company behind the entity. SoftBank is Foxconn's counterparty in the transaction, the people said. Representative for SoftBank declined to comment. Foxconn did not respond to an email seeking comment. Participation by Honhai, an investor in SoftBank's first vision fund, would be a boon for SoftBank founder Masayoshi Son's grandiose plans to be at the center of surging investment in AI supporting hardware. The Taipei-based company would operate the plant and use the site for its own AI server manufacturing business. Bloomberg News reported the Ohio site may be used to host a data center, a person said. Look, this was going to be an EV plant. Foxconn bought this plant in 2021. I think they paid like $180 or $200 million for it. Now they're selling it for $375 million to SoftBank, who's going to turn it into some kind of big AI data center server manufacturing facility. I don't know what this is really going to result in. Masa-san has been on the kind of in the spot right now. He's got to do something. He's got to start spending some money. He promised to spend $100 billion right away. He hasn't spent any of that yet. There was this article yesterday basically saying we can't agree on how quickly we're going to freaking, depreciate this AI hardware, which loses value incredibly fast. So this is either a serious move or this is just something to placate the headlines to be like, oh, yeah, we're spending the money. Sure. Either way, SoftBank doesn't have the $500 billion that they promised to spend on Project Stargate, so they're going to have to go raise that from someone who, your guess is as good as mine. Meanwhile, check this one out. Trade Desk stock tumbles after earnings. Are investors being too harsh? The ad tech company fails to deliver meaningful upside with its outlook and announces a change at CFO, but the results for the latest quarter beat expectations. This one's kind of a head scratcher here. After running up 56% over the past 3 months, Trade Desk shares are now falling hard. Is the move justified? While the advertising technology company's outlook didn't offer much upside and the company announced the departure of its CFO, Trade Desk did beat expectations with its latest sales, but the stock's 29% after-hours plunge on Thursday would translate to its second worst day on record if it holds through Friday's regular session. Investors seem to be punishing the company hard for its September quarter outlook, which calls for at least $717 million in revenue. Analysts were modeling $716 million, but perhaps some of Wall Street were looking for more in light of the stock's strong recent ascent. Trade Desk $277 million outlook for adjusted earnings before interest, taxes, depreciation, and amortization also only matched the consensus view. All right, so their guidance was only in line, and this is a company that has rallied significantly recently, so maybe that guidance was a little disappointing, but I think this is really the issue that's causing the sell-off. CFO departures can spook investors as well, and Trade Desk said that Laura Schenking will transition from CFO after more than a decade in a series of financial leadership positions with the company. She'll be a non-executive officer for the balance of 2025, supporting Alex Kale, who will be named successor effective August 21st. Kale was already a Trade Desk board member and brings experience leading Salesforce venture operations. So they're replacing their CFO with a board member, and the current CFO is getting demoted, not offering any reasons why. Typically, CFO changes like this coming up unexpectedly precedes something pretty awful, and I think that's probably what's got the market worried this morning. Either way, this stock is just getting absolutely hammered ahead of the opening bell. Now down 36%, trading at $56.54. Now, look, year to date, the stock is down 24%, although it's pretty much flat versus a year ago. The stock had a pretty nice run. You can see from 2023 to 2024, the stock rallied from down in the 40s all the way up to 140, now trading just down at 50 and change. Changes in the C-suite typically worry investors. Meanwhile, Wendy's cuts profit outlook as U.S. sales stay weak. Its stock heads for a 5-year low. The earnings were pretty bad, but to be honest, the stock is holding up all right this morning. Wendy's stock dropped in pre-market trading, heading towards a low not seen in 5 years as the fast food burger chain cut its full-year outlook and sales outlook, saying that its U.S. business continued to weaken. Wendy's reported overall sales that fell 1.8% from a year ago as U.S. sales dropped 3.3% to offset an 8.7% jump in international sales. Same-store sales, which are sales at stores open at least 15 months, declined by 2.9% as they declined 3.6% in the U.S. while rising 1.8% overseas. That same-store sales number from Wendy's, that is just terrible. Look, the restaurant business has been in dire straits recently. McDonald's has had some success offering discounts and promotions to try to get people back in the door, and it looks like they're capturing market share from the likes of Wendy's by doing that. Although Wendy's stock right now is holding up all right. It's actually up 1.1% on a big decline in same-store sales. Although let's put that in perspective, shall we? Wendy's year-to-date is down 38.9%. So it's been a rough year for Wendy's. Now on what looks like some pretty good news, Block stock pops after earnings as its two financial engines reignite. 3 months after posting one of its worst drops on record, Block stock was powering higher late Thursday in the face of renewed business momentum. The company, which is the parent of Square and the Cash App, saw 14% growth in gross profit during the second quarter, showing an acceleration from the 9% rate seen in the first quarter. Those two major business units saw their growth rates pick up as well. On a dollar basis, Block's gross profit amounted to $2.54 billion. That's above the $2.46 billion that analysts tracked by FactSet were modeling. While CFO Amrita Ahuja acknowledged a dynamic environment for the economy, she said Block's business has shown resilience. Not only did the company accelerate gross profit, a metric Wall Street views as a proxy for Block's revenue, but trends at Square and Cash App suggest healthy business and consumer activity, she added. So I'm not sure about that whole acknowledging a dynamic environment thing. That's kind of like saying, look, there could be some pain on the horizon, but those are some pretty good growth numbers from Block, and Block is a name that's kind of taken a beating as of late. And so shares in this company are looking really good this morning, up 6.35%. They were up 8% in change ahead of the opening bell, so we're giving back some of those gains. But signs of encouragement from Block this morning. Now let's talk about something that I find rather discouraging. Rolls-Royce nears a deal to offload their £4 billion UK pension pot. And guys, I'm seeing a lot of this recently. I saw an article about this last week. Companies in the UK are selling off their pension obligations, and I'm worried about what that might mean for people. Rolls-Royce Holdings is nearing a deal to offload its UK pension pot to an insurer, a move that would take almost £4 billion, or about $5.4 billion in liabilities off the aircraft engine maker's balance sheet. The biggest UK manufacturer may announce a deal with pension buyout firm Pension Insurance Corp as soon as this month, according to people familiar with the negotiations. Talks could still be delayed or fall apart, said the people asking not to be identified, discussing private information. A buyout of Rolls-Royce's pension would be the largest UK risk transfer so far this year. The UK engineering company, which has about 21,000 employees in the UK, has overhauled its retirement fund over the years after being forced in the past 2 decades to plug shortfalls that weighed on its earnings performance. The UK's pension buyout market, where firms pay insurers to take on their financial obligations to pensioners, has been booming in recent years as higher interest rates reduce the value of plans' liabilities. The improved funding levels have made buyouts more affordable and led many large British companies, from pharmacy chain Boots to insurer RSA and lender NatWest Group, to offload these liabilities to focus on their core businesses. Okay, look, so at the end of the day, this shouldn't affect the pensioners, the people who are owed this money. It just means instead of being owed from the company, now they're being owed by this insurance company. What I worry about is these insurance companies are typically owned by private equity firms and asset managers, And those insurance companies are also making very large loans to those same private equity firms. So there's a little bit of an incestuous relationship going on between the insurers and their private equity masters. And now those companies are taking on pension obligations. It's almost like they're buying themselves some human shields, because nobody's going to let a firm fail if it takes 21,000 people's pensions down with it. And I'm worried that this is actually some kind of a plan to get themselves protection from the government. It's like, oh, you can't let my firm fail because people will lose their pensions. Therefore, I am magically too big to fail. And a lot of this is happening in the UK. So keep your eye on this, guys. Again, I don't think in the short term, I don't think this means all that much, but this is something that is picking up steam. A lot of companies are doing this. And the last one of the day, China car sales slow as anti-price war drive hurts demand. We've been talking about these China EVs recently, and it looks like it's starting to have an effect. China's pledge to end the car industry's brutal price war appears to be paying dividends, as fewer models were discounted last month, though the push is hurting sales. In July, 17 models had price cuts, the Passenger Car Association said in a statement on Friday. That's down from 23 the same time last year and in line with July of 2023. Overall, retail car sales fell 1.8 million units in July, down 12% from June. Sales grew 6.3% year on year, slowing from the roughly 15% pace seen each month between March and June, the PCA said. Summer is typically a quieter period for vehicle purchases. China has intensified scrutiny of its auto sector on concerns the extended price war that's plagued the industry is unsustainable and risks sending weaker firms into bankruptcy. Officials summoned the heads of major electric vehicle makers, including BYD, to Beijing in early June, where they were told to self-regulate and instructed to not offer unreasonable discounts. And in China, when the government makes suggestions like that, they're not really suggestions at all. You tend to disappear if you don't follow them. And so we got far fewer discounts being offered by the auto industry in China, and it is hurting sales big time. The Chinese were worried this price war was basically going to result in factories shutting down because a lot of these EV makers were not paying their parts distributors. And so those parts distributors weren't able to pay their employees. They were worried about a wave of layoffs. Instead, they're just selling fewer cars. We suspected something like this would happen when that meeting was announced back in June. We covered that on this channel. Now we're seeing the results, a big decline in those tariffs, or in those vehicle sales. Sorry, guys, I got tariffs on the brain this morning. And I just want to say thank you very much to my man, Mish the Mod. What's going on, Mish? Thank you so much for gifting 10 Nobody Special Finance memberships. That is very generous of you, sir. And hey, if you received one of those memberships, be sure and say thank you to Mish in the chat. And just a reminder, guys, all Nobody Special Finance members get one free super chat a month. Feel free to use that, and I will read and respond to your questions on the air. Hey, welcome to, how do you pronounce that? Is that Pestilence? Okay, Pestilence. Welcome, Pestilence. What is it? War, death, famine, and pestilence. Is that the four riders? What are they called? The four horsemen of the apocalypse? Well, we got one is now a YouTube member. Thank you so much for the support of the channel. I appreciate that very much, and welcome to the Magnanimous Melonheads. Armando Reyes, thank you, sir, for the super chat. He says, on the brighter side of news, the U.S. sent Dark Eagle hypersonic missiles to Australia. Be ready, get squared away, and stay frosty. You know, I haven't read much recently about the U.S. hypersonic missile program. I know as of this time last year, we were largely considered way behind the Chinese and the Russians in this category. So I don't know much about this Dark Eagle missile. I suspect we have redoubled our efforts in this category. And the fact that we're sending them to Australia, well, that is conveniently a hell of a lot closer to China, isn't it? I suspect that is not a coincidence. Be squared away and stay frosty indeed. Hey, guys, just a reminder, there's still time to switch this thing off. The whole World War III thing doesn't have to happen. You don't have to invade Taiwan. You could just leave them alone. I mean, just throw it out there. You could just leave them alone. Like, live and let live. What a freaking concept, right? Thank you, Armando, for supporting the channel. And thank you, Charles G., who says, I got sleep last night. Ric Flair. Woo! All right, Charles, congratulations on getting some sleep last night. I guess Chuck was having trouble sleeping. Maybe it was just, you know, the comfort of knowing tariffs on gold is going to cause a blowout in the New York futures price. Maybe that's why you just rocked you right to sleep. The sound of shorts rushing to cover their trades. Or maybe just rocked you right to sleep. All right, Charles. Glad you got some sleep, brother. T.A. Chapman also gifted 10 Nobody Special Finance memberships. Thank you so much, T.A., for supporting the channel. Guys, if you got one of those, again, say thank you to Mish. Say thank you to T.A. And may the odds be ever in your favor. Uncle Fedster says, happy Friday, Jack. You would think they would want more true money to flow into the country. That is possibly the unintended consequence here, Uncle Fedster, is, tariffs are a barrier to entry. And don't you want more gold in the country, right? Possession, 9/10 of the law, whoever's holding it when the music stops. I suspect, I have a sinking suspicion that this tariff may be leading to a revaluation of gold. The reason why, let's say we get this short squeeze is engineered. We see the New York COMEX price just rallies dramatically. Say it goes up a few $100. The biggest holder of gold in the world is the United States, or at least we're supposed to be. That whole audit Fort Knox thing, that disappeared from the headlines real fast. But let's assume the gold actually is there for a second. If we get a big blowout in the futures price, maybe the Treasury goes and says, you know what, we're revaluing our gold to the $5,000 it's trading at in New York now. And well, since we have 880,000 tons or some ridiculous number, the biggest holdings of gold in the world here in the U.S., we revalue that from the current $44, I think it's valued at, or $40 we have it valued at, to something closer to $5,000 an ounce. Well, that's a lot of magic money that suddenly gets poofed into existence, deposited in the Treasury General account, and then the government has all the money they need without issuing any new treasuries, and then they can just blame the inflation on, I don't know, Rosie O'Donnell. It's her fault. Blame her. That's probably, or I suspect that may be where this is headed. This may be a step in the direction of getting gold prices higher so they can revalue gold and print the money. Thank you very much, Uncle Fedster. Appreciate the support of the channel. M&J gifted 10 Nobody Special Finance memberships as well. All right. You got to thank Mish. You got to thank TA. And you got to thank M&J, ABC, CDEFG, all of them. Thank you guys so much for gifting all these memberships. And again, all you guys, be sure and say thank you and welcome to the Melonheads. Thanks again, M&J, for everything. T.A. Chapman is back again, says, do we think the silver-gold difference in China will go boom with this tariff in place? No, I don't think the tariff will drive the premium higher, because right now the big difference with Shanghai gold is trading at a higher price versus the London price. The tariff is setting the New York price higher than the London price, or driving it higher. Now, what does that mean for Shanghai? I don't know. That's interesting. But one thing that it might do is it might drive more international trading onto the Shanghai Gold and what is it? The SGFE, the Shanghai Gold Futures Exchange. It's a relatively new exchange. But if trading in New York means you need to deliver your physical in New York on the wrong side of that tariff wall, well, maybe you can get the same futures price exposure by trading in Shanghai without having to deal with those tariffs. Just one possibility. As far as the arbitrage, the difference between the gold price in China and the U.S., I don't really know what that result is going to be. Right now, all the focus is on the difference between New York and London. That's the big one. Thank you, T.A. Chapman, for supporting the channel. M&J, 10 more Nobody Special Finance memberships. All right, we're up to 40 new Melonheads right now. We are legion. Thank you so much, M&J. Appreciate that very much. Welcome to the Melonheads, everybody. Armando Reyes says, I hope all these CEOs don't start jumping. Maybe jump from the first floor. I don't know. Just a little safety advisement here. Look, I'm guessing this is in regards to that trading desk story is when this one came out. I don't know what's going on at trading desk. A little bit of a disappointing guidance there. A sudden change of CFO, never a good sign. All right. And the way they're changing it, they're demoting her and they're appointing a board member to fill her job. That just smacks of something went wrong in the books there. I don't know what it is or what it could be. And right now the market is just deferring on the safe side until they get more clarity. And they're deciding when there's questions about the C-suite and the CFO role, I don't want to be holding that stock. I'd rather just take my gains. And Trading Desk has had a pretty good couple of years. So there's plenty of gains, plenty of profits to be had. So that's what's going on. Are the CEO is going to start jumping? Probably not yet. Thank you, Armando, for supporting the channel. Robert Feeds the Machine says money. I'm Jack Gamble, and I approve this message. Thank you very much, Robert, for feeding the machine. Appreciate the support of the channel, sir. M&J is back again. Okay, that's 50 today. Wow, M&J, you're going member crazy here today. Is there something going on in the chat with the memberships that I am not privy to? Why am I always the last to find out about these things? I don't know, but thank you so much, M&J, for everything you do for the channel. Uncle Fedster has been a melonhead for 17 months. He says, grower older with NSF. I agree with the revaluing of gold. All right. So, hey, we're just spitballing on the gold revaluation. Personally, I don't think it's a good idea because gold revaluation is technically just money printing by another name. It's really the end result is the Fed prints money and deposits it at the Treasury General account. Now, in the long run, gold revaluation may eventually lead to higher gold prices because it would show a more dovish monetary policy, the Treasury and the Fed conspiring to increase money supply. In that scenario, you want to own some gold. So the knock-on effect, the secondhand effect, may be higher gold prices eventually, but a revaluation of gold will not immediately affect the gold price that dramatically. It just increases the money supply. That's all it really does. But I suspect that's where they're going with this. Thank you so much, Uncle Fedster, for supporting the channel as a Melonhead member. Guys, appreciate all the super chats this morning. Did I get through all of them? I didn't miss anybody, did I? There was a lot of them this morning. I apologize if I missed anybody. We'll get you on Monday if I did. But for now, I just want to say thank you so much for all the support of the channel, as well as you, my magnanimous Melonheads on YouTube and Patreon. Looking forward to talking to you guys this afternoon at 2 p.m. Eastern Time for our weekly get-together on Zoom for Q&A. Links down below to all that good stuff, should you feel so inclined. Don't forget to hit that like button and that subscribe button on the way out. Hi, Mom. Hi, Dad. Love you guys. Everyone, till next time, live small and dream big.